Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of UK rate strategy, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Okay, Jan, I'm going to start with you, not just because I'm super excited that you're back, but also because clearly the main mover of markets this week was US inflation, so it makes sense to start there. Looks like very good news. Is that the right take?
It is the right take. Yeah, finally, macro data supporting a little bit what kind of how we see it evolving. Just to kind of give a rundown of the CPI to the listeners, without going into extreme granularity, but it was good news. If you want to take the main message from what I'm about to say, it was really good because it decelerated not only below what we expected, but across, from most economists' consensus that I've seen, certainly below where the market was pricing in, like the inflation fixing markets. Just to give it context, the core number, which excludes energy and food, the food increased by, technically it says 0.2, but it was really 0.16 unrounded. So it's a very, very sharp drop after 0.44 the previous month. So you can see kind of like a sizable deceleration. Similarly, the headline index was up 0.2, but unrounded it's 0.18. So like soft numbers, and even more importantly, no matter how you slice and dice it, at least I couldn't find anything to pick and say this is like kind of like the one-off, or it's like an outlier print that should be mostly treated as noise. Goods prices within core goods prices within the index fell by 0.1%. So we expected to see a weakness in used car prices, which is now already materializing in the actual index too. We think that should be the case for the next few months as well, as we've kind of been hinted by alternative measures. Similarly, core services, which gained particular attention throughout, like the post-COVID era, as it has been the main source of inflation and spending in the U.S., moderate to 0.3 from 0.4. And our economists estimate that what we call the J. Powell measures, so that the core services ex shelter CPI is 0.1%. So you're seeing a significant deceleration. Similarly, rental components that go within the inflation index continue to slow down. The owner's equivalent rent, the OER, fell to 0.4% from 0.5. So all of these are good signs, because we knew that slowdown was going to come in rental measures, but it was just a question of how long it's going to take to be officially reflected in the main metric. Granted, I will say that optically, the one perhaps counterpoint to what I'm saying, what I just talked about, is the year-on-year figures benefited a lot from so-called base effects, because numbers that were large monthly increases from previous year now got dropped out as you calculate the previous 12 months. So it looks like the year-to-year numbers fell really sharply. That won't be the case going forward. We're not going to see these sharp, like over 1 percentage point changes in the monthly year-on-year figure. So good news, like you said, rates really rallied. Today seems to continue post PPI. So maybe we got a little bit of a reprieve from all that super sell-off that we had first week of July.
Let's see. I want to come back to the US. I haven't finished with that, but I think whilst we're on US inflation, it's probably worthwhile just doing a quick round trip through the rest of us in terms of what it means for our markets, because we saw not just a big reaction in US rates, but clearly in the UK and Europe as well. So Giles, perhaps you can just kind of give us your take in
Right. So I definitely think, I completely agreed with Jan. This is one of those outlier prints which I think has a lot of signal. It's really, it doesn't look like noise. The only thing I might call out personally as potentially a little bit of a question was the airfares, which did seem a little bit on the low side. So maybe a bit of a question mark around that. But broadly speaking, yeah, it was surprisingly and very good news. And no, I just really want to emphasize again, I know that Jan's already mentioned it, but the J. Powell sub-index, this services ex rent, I often just look at the seasonally adjusted monthly change annualized, just to kind of a version of a kind of spot inflation, if rather than looking at the full 12 months look back, which is what you have when you get the year on year. And that was what Jan was talking about in the context of those base effects. Now, it seems like that had already come down to almost zero, actually, and has been bumping around that kind of level since February. All right. And yesterday just confirmed that again. There was only 1 month in about 5 where it was reasonably high and still below 2%. So, I do think that taken together with the other signs, things like slowing average hourly earnings, for example, the fall in the vacancy rate. I'm not here to talk about the UK, so the US any more than that, but it seems like you've got a fairly coherent picture here, whereby really, the characterization I would give is the soft landing seems to be maybe back on the table here. And so with that, naturally we're all asking ourselves, okay, inflation emerged suddenly in advance of everywhere else in the US. Is this really what? If I look sort of 6 months in the future, is this what we should be expecting in Europe or not? And the honest answer is, it looks far more likely, I would say, when you see what's happening in the US. So my conviction about this high sticky inflation is a little bit shaken. I'm very happy to admit that. Against that, I would say it does seem like there are some other dynamics going on in Europe. The terms of trade was the shock there was deeper, and so it seems like maybe there is more kind of of this sort of pass the parcel kind of inflation. The tit for tat, everybody trying to call back what they lost. Maybe that just runs deeper. We have higher wage inflation now in Europe. This isn't a new thing, by the way, but now we have higher wage inflation than in the US. I think food price inflation is still an important factor. There's nothing really that hits people more profoundly, I would say, than food prices. And whilst that has come right off in the US and was never really as high as in Europe anyway, it's still pretty high in Europe. And things like drought and El Nino and all these kinds of things, they're still there in the background. It can still be a little bit of a problem here. So I think you are looking for more evidence here, but certainly actively looking, because this is open to question.
Yeah, and I guess just to follow up the discussion on the UK side, everything you just went through there, Giles, about the reasons why you might be slightly more optimistic but still cautious in Europe, is probably even more so relevant in the UK when we're talking about this terms of trade shock, when we're talking about the tightness of the labour market and wage inflation. There's more cause for concern, I think, in the UK than we're seeing in the US. And although I think that the market pricing that we now have, after the major sort of repricing that we've had this week following the US inflation print looks more sensible, it's repriced kind of in a more dovish direction, which was in line with our base case. It did feel like a little bit of an overreaction to me, because I still think that the outlook for UK inflation is very different to, that of the US. I was just making a chart as I left the desk to put into the weekly that looked at, inflation, both headline and core, across the US, Europe, and the UK, with, where it's been over the last couple of years, but then also our house views. And I think it's easy to get swept up into a positive US story, but you have to remember that we get UK inflation next week, and we think that that's going to accelerate again on the core level, and like I say, when that comes against the backdrop of accelerating wage inflation as well, it's difficult to see the BOE taking its foot off the gas in that environment, even if the US is slowing and and the Fed doesn't need to hike perhaps as much as, well, certainly, as much as we thought, given that we'd always been on the more dovish side, but perhaps less than the market was thinking. So, Jan, back to you then. What does that mean for your Fed call? I kind of teed that up there without thinking that through very well, but we haven't caught up since payrolls last week, which ultimately were kind of firm enough to add in a hike into our base case forecast in July. While you've been off, we've had Kevin kind of replacing you on the pod for a couple of weeks, and he obviously talked a lot about how the risks were skewed in that direction. But it felt like a kind of solid enough NFPs following a beat on the ADP was enough to kind of add that hike back in July. How does this inflation print make you feel about that? Or I guess more importantly, hikes or cuts beyond July?
Unfortunately, I think the kind of like the die for the July meeting has already been cast, and we're not really, it is unlikely that the Fed will walk that commitment back. That being said, we do think that July will be the final rate hike of this cycle. We're watching measures like the ones I pointed out, like core services like shelter that Al has pointed out many times, and we do think those will, like not on a year, but like on a, let's say, 3-month annualized basis, they will show sufficient slowdown to justify not only pausing, but perhaps even a turnaround at the near December meeting and maybe lowering rates, because at some point I think we have to talk about the impacts of lagged and the so-called like the variable lags in monetary policy, and you look at it from the growth side, and you have seen some impacts of the rate hikes, but I think a lot of them are still yet to hit the economy, such as corporations with their rock solid balance sheets are still just starting to refinance at higher rates. Consumers are spending in a rather almost like a nihilistic fashion. We're not really seeing a significant slowdown that you would expect given the change in interest rates. Yeah, the housing market slowed down, but it's really like a collapse in the amount of transactions as the because of the structure of the market, like people are just not selling as they locked in their 30-year fixed mortgages at 3%. So there's still a lot to be felt, I think, if rates stay at these levels. So it wouldn't make sense for us to tweak them a little bit lower into the end of the year if inflation is going back to target. You don't necessarily have to you don't necessarily have to orchestrate a collapse in activity unless you want to. But this all kind of points out that the soft landing might be back in play. We'll see how it goes out. Of course, there's like some risks that we might not be aware of, but we think July is a hike, and after that, there's going to be sufficient progress to show that they wouldn't have to go again. That is very different from what's their latest projections that the Fed released in June, which showed that they plan on hiking 2 more times this year. So it'd be more in line with how they saw it kind of playing out in March, for example, not in June.
What about in Europe, Giles? We've had a week where the voice of the dove seems to be growing, or seems to be getting a little bit louder. We're recording this on Thursday, so we've just had the minutes from the last meeting. But we also had a kind of lengthy Lane speech yesterday where he seemed to lean a bit more dovishly, and other speakers, I suppose, that have also been leaning that way anyway, but growing a bit louder. How do you think that kind of, which side of the coin does that settle on for, I guess, July and beyond? Is it the same as the Fed, where the die is kind of cast for July, but the jury's certainly out for beyond?
Yeah, I would say so. Basically, I would say that the way that we very often watch central banks, particularly the ECB, I would say, is not so much by paying attention to what the central bank speakers are actually saying, because usually they're just repeating things that we already know. We already think about these things. It's very rare that somebody comes out and says something dramatically different. I mean, of course, that happens from time to time. You have to be alive to that. But usually what happens is that the mood with hawks, or in the hawk camp or the dove camp, can be measured by how keen they are to get out there and present their message vocally and forcefully. And as you say, yes, we have had a conspicuous sort of rush of doves. And so we've, just to name a few, they're all the usual names, right? I mean, we've had Visco from Italy, who is talking about a pause not being far off. Stornaras from Greece saying that July is not a holy promise. Villeroy from France, I mean, he's really, I would take as the sort of most influential and, sometimes swing member, actually, but most recently more on the dovish side. I mean, he was talking about being near a high point in rates, having had just had some good news on inflation, or starting to have good news on inflation, I should say. Being past the peak, in fact, in France. I mean, it's a statement of fact, of course, depending on exactly how you measure inflation. But certainly, if you're looking at year on year, there's nothing surprising in all of that. But nonetheless, I think it's important to just gauge the tone there. Lane, well, I mean, you said that he was on the dovish side. I mean, compared to where he has been all the way along, I wouldn't say that he was especially on the dovish side. But yes, indeed, he was reasonably dovish in this speech that he gave yesterday, talking about, or just re-emphasizing, I suppose, the long lags with which monetary policy operates, and therefore, you don't need to constantly ratchet up higher and higher rates, because actually you're just going to end up overdoing it, basically. The minutes, I mean, the problem with the European central bank's minutes, of course, is that they very rarely tell you very much about how many or what the depth of support for various arguments on either side of the inflation were. They just say a point was made and another point was made. You sit there going, yeah, well, no, I'm not surprised that point was made. There's nothing that we haven't really thought about here, but I'd like to know a little bit more about how much weight people have been putting on these things. So I didn't really get an awful lot from those minutes, other than just the reminder that there was really no discussion about September. It was all about they need to raise rates in June, probably in July, in order to validate the economic projections that they had just produced, which basically assumed those two moves. So those are kind of baked in the cake. So to go back to your actual question, is July baked in? Probably. Is September? Definitely not. Markets are pretty close to pricing that in fully, but not quite anymore. And I think that could probably come off a little bit further.
Okay, great. Before we move away from Europe, the only other thing I think you've been talking a lot about this week is Spain and Spanish elections. I know we have kind of talked about them a couple of times on the pod previously in terms of things to watch out for over the summer, but given that they are next week, I think it's probably worth a revisit of your views and how much you think they might matter for spreads going forwards.
Yeah, well, I'll try and deal with it quickly since I spent so long on the last one. I mean, we're positive on Spain. I don't think that we're necessarily especially out of consensus on that, but when it comes to the political risks, they look pretty benign. I mean, it looks likely, perhaps very likely, that we'll end up with a government led by the centre-right People's Party, and whether that is there'll be various other parties. You'll learn this sort of further right-wing Vox party, which I think they have a history of Euroscepticism, which they can double down on in their manifesto. But frankly, that's not going really to come to anything in any government negotiation. So, and I don't think that that's how markets typically like governments that are that come from the right or the center right. Whatever your politics, empirically, I think difficult to argue about that. And so I imagine that will probably be at the margin positive. Now, the risk scenario is possibly that there's too inconclusive a result for us to proceed quickly to the formation of a government. In 2018-19, there was actually a series of elections because Spanish politics was so polarized, and that the parliament ended up so divided that they just kept going back to the country. And I think that would be a pretty negative outcome, but I don't expect it. I mean, it would especially be negative, I suppose, just in the light of the recovery fund, who's going to be managing that. How distracted would the caretaker government be? And in particular, what happens if we head towards a recession? Not necessarily my base case, but if that were to happen, I think that the political uncertainty would interfere negatively there. So that's really the downside scenario, but I'm not putting a lot of weight on that. Okay, so maybe we can just end up in the UK and bring it back to you, Imogen. So in the UK, we've had out of the Bank of England a financial stability review. We had from the OBR their fiscal report, and so I suspect that there's probably some bullet points you might like to draw out for us from all of that.
Yeah, although I will just add before I say anything that the market doesn't care about any of those things and seems to only care about US inflation. So perhaps it's not really worth my time this week, but there we go. Even the labour market data can elicit much of a reaction in the UK. But anyway, I think that, the two financial or fiscal stability reports have been a little bit telling. I guess the BOE one first, I was most focused on how they talked about the risk to households and this transmission channel from higher rates via mortgages and how they spoke about that and the impact that they see. I felt like they had quite a benign assessment of, how high debt servicing costs might rise and how much of a drag this might be on consumption. Part of that was because they looked at debt servicing costs across the whole economy rather than just of mortgage holders themselves. And part of that was because they didn't also include rental payments in their debt servicing costs. It was strictly mortgage payments. So clearly, you get a little bit of a skewed look at just, how benign, therefore, that transmission channel might be, which I guess at the margin is a little bit hawkish. We've talked before about how renters are also going to feel the pinch, and that, a lot of mortgage holders, they are also at the part of the income distribution where there isn't a huge amount of saving stock, and they won't really be able to withstand this hit from higher rentals particularly easily. Ross is working on a piece right now, but the updated data shows that, for a median income household, they spend about 50% of their income essentially on essentials, that's sort of food, travel, and housing. And so there's really not a lot of wiggle room there for big increases, whether that be in mortgages or in rentals. But I did think that the BOE's assessment painted a relatively benign picture of just how much of a drag this kind of rise in interest rates could be, which I guess at the margin is a little bit hawkish, because if they don't see such a big drag on consumption, from the rate hikes that they've done so far, then perhaps more needs to be delivered. And that was reinforced a little bit by Bailey's Mansion House speech. I mean, nearly all of it wasn't focused on monetary policy, and the part that was anyway was a little bit repetitive from what we've already heard. But one thing I thought was quite interesting was when he talked about the tightening that was still in the pipeline from this lag transmission mechanism. He said that there was some tightening still to be delivered, which I felt like was a bit of a disingenuous representation of just how much tightening was still to be delivered. If you look at the Bank of England's effective interest rate, which is essentially the kind of weighted average interest rate on the outstanding stock of mortgages, that's only risen by about a fifth of the tightening that has been delivered so far since, end 2021. I think by the time that we had the cutoff of the data, there would have been about 450 basis points of tightening delivered, and only about 70 basis points of that has made its way through to an increase in the effective rate. So I think there's a little bit more than some tightening still to be delivered. But again, it speaks to this idea that perhaps the BOE are taking a more benign assessment of just how, large this hit could be, and therefore, again, at the margin, leans slightly hawkishly. The OBR's assessment in their kind of fiscal sustainability report was perhaps a little bit more sobering. I think they painted a relatively dire picture of public finances in the UK. A lot of their scenario analysis was focused on their long-term forecast. So, they were talking about debt sustainability in 2070, which I'm not sure the market cares all that much about necessarily. We'll be a bit more focused on the near-term numbers, but certainly the tone of, their evaluation kind of gave us a good steer for just how we might be expecting their forecast to be revised in November. And the numbers that we did get in terms of kind of near-term projections, I don't think painted a particularly positive picture. They said, all else equal, just between March, when they made their last set of forecasts, and June, the rise in bank rate pricing and the rise in gilt yields would suggest close to 14 billion additional interest rate expenses by 2027. And the kind of updated assessment of how much they think QT might cost, given how bank rate expectations and how gilt yields have risen since they made their forecast in March, would add about an additional 55 billion in terms of net cost to QT. And all in, they only had the overall net cost, i.e. taking account of the surplus or the profit that QE provided for a long time, of 60 billion. So that's essentially a doubling in their cost of QT, their net cost of QT, which is pretty sizable over the lifetime of the APF. So they were very clear that this wasn't an update to their projections and that they haven't formally run those numbers. But I think it just served to reinforce these upside supply risks that we've been talking about for a long time. And, listeners or readers of our research will know that the upside risks to supply is one of the reasons why we're still bearish gilts. Even though we reached that 4.6% target, we still think that an overshoot is quite likely. And that we wouldn't kind of fade that cheapening in gilts 10-year gilts until they got to 4.9%, because I do think that the risks on the supply front are skewed very heavily to the upside. And this is one of the major drivers of that upside risk is just this kind of interest rate risk and how much more the debt pile is going to cost the government in the years to come. But I will stop there because that certainly wasn't the main event or the main market mover this week. So thank you both for joining me, and thank you to our listeners for listening in. Just a reminder that if you like today's episode, please don't forget to hit the like button or click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.